The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, as always, there's things that are new and then things that are just a review in the market. There's an old adage, I'm sure you've heard it, history repeats itself. Well, it may not exactly repeat, it kind of looks similar though. And that's certainly been the case with a lot of the economic data and some of the volatility data that we've had in the past couple of weeks in the market. So we're going to kind of brush through some of these things and see if we can give you some sense of that there is order and system in place to get through all of the uncertainties which are before us. And Lord knows we have plenty of uncertainties coming up.
That we've got. Yep.
The big one this week happens to be the Jackson Hole, Wyoming confab, where central bankers from around the world, mostly friendly countries, come in to meet with Chairman Powell and the other Federal Reserve Bank presidents to present ideas about how do we manage the global monetary system more efficiently, or at least more interestingly. I'm not quite sure what their total objective is, but everybody has a theory, and here's where they get to hash them out and say, well, that didn't make any sense, or maybe that one did. One of those rules that has been in the news of late has been the SAHM rule, SAHM, which was created or established, figured out by Claudia Sahm. She's an editorial writer. God, I want to say she's at the Journal, but maybe she's at the Washington Post. Irrelevant. She's a smart lady.
And economist, yeah.
The SAHM rule basically says that when that you have a recession coming, when certain data points are hit, and we hit one of those a week ago Friday, and all of a sudden fear of recession became a major headline, while Ms. Sahm says, don't worry about it. It's not all that big a deal. There's so many other factors in play. But we understand. Let me bring the chart up here. I share the screen.
And that's to her credit, I think, to come out and say, yep, that's it's my rule and it's my indicator, and it can indicate a recession, but it doesn't mean we're finished now. There's no such thing as one indicator that ever repeats itself over and over again without fail. Not in economics. That's why it's called the dismal science. It's more or less we're looking for trends, directions, and possibilities, not for absolutes as well. The sum that this has been triggered, that means we're having a recession no matter what. It just doesn't work that way.
So basically, it's the 3-month moving average of unemployment rate moves above a half a percentage point or more above the 12-month low. And the chart we just put up on the screen, that basically shows that. So that happened. But then Chair Powell was asked about it, and he basically said, well, things are historically significant, but as you just said, Perry, they aren't all predictive. The stuff doesn't always follow the way you think it would. So you can't use it as a buy-sell decision. We should be out of the market because we're going to have a recession. Well, actually, we're going to have a recession. What the Fed does to try to reverse that often causes the market to go higher before it rolls over and goes lower.
It still has a recession, yeah. So
we still get one. It's just that it doesn't happen quite as fast as some of the data is believed to cause it to happen. So
And we're
we
still
have
close
enough.
enough to the COVID interventions. Claudia said, that there's still lingering pandemic effects in the economy because there was such massive economic displacement, as they put it. There was so much money just poured onto the economy that it distorts many other factors down the line, and it takes a long time to get that much cash back out of the system. And it does move things around. And it is, again, to her credit, to note that this is not an ordinary reading, not during ordinary times. Things have been radically altered by our friends in Washington, D.C. And you need to keep that in mind when you're looking at these numbers.
Well, it's not just these numbers, it's any economic data.
Yep.
It's all been messed up as a result of government intervention during COVID and their inability to just simply unwind it and their fear for doing so. I mean, they were fearful. They're supposed to be the elite, smartest financial people in the world leading our monetary system, and yet fear overcame them. Fear overcame Congress. Well, we would expect fears. We don't always have the most elite people in Congress.
Isn't that the truth?
Yeah, that's right. The one that comes to mind is the senator that said he was concerned about putting a military base on an island because the island might tip over.
Yeah, there we go.
I think that happened.
Glad he's in charge of something. Yes, that's good.
Right.
So,
Anyway, one of the issues that is an item of concern is this one right here, which is the unemployment rate. And unemployment really has to hit much higher numbers before we're going to be looking at recession. Now, maybe we're in the early stage of recession. That's a possibility.
Sure.
The Somme rule could be reflecting the start of a recession. But the Fed is always late to the game. They're late to stimulus, and they're late to restraint. So we can't really look at the Fed and know what's going on. All we can do is react to their reaction. Because bottom line is they're still people too, and they are going to have emotional commitments that interfere with their decision-making process. That's where rules come into play, and why we keep relying on process for investment management. The rules are, boy, I don't want to make this trade. We just went through that.
We did.
In the most recent portfolio readjustment, the leadership was one that we'd say, man, rationally, I'm not sure that makes a lot of sense. But the market is taking us in this direction. And if that's where leadership is, that's what we want to own. We can talk ourselves out of it, and many investors do, because they buy on belief or gut reaction. And when it doesn't work, they walk away and say, well, it will eventually, because the market always goes up. But when we're talking about recession, we need much higher unemployment. And right now, we only have 2 job openings per unemployed person. We need a lot more unemployed people banging on doors saying, I need work or I need unemployment compensation. That's what typically happens in recession. But if you think, if for those of you who lived in the Puget Sound area back in the 60s or 70s, when the SST project was canceled, Boeing shut down that project, and Seattle basically became an almost vacant city. I mean, wherever you went, people were depressed because they were underemployed if they had a job. They were looking for work, another job, a better job, one that has more hours and more pay. But this is another piece of information that just basically doesn't suggest a recession decision by the Fed is critical. We're going to, this Friday, I don't know when this podcast posts, it might make it before Friday. But anyway, the end of this week, we end up with the Fed speaking from the Jackson Hole meeting. And the market's going to make an adjustment. Depending on what Chair Powell says, the market is either going to feel elated and happy or depressed and sad, and prices are going to follow either way.
And that's the way that always works. And that is That is because so many people and so many institutions trade on the narrative. They trade on the headline, and it's going to be, oh, well, this is what this means. Then this is what the Fed's going to do. So here's what we're going to do preemptively because we're going to come out ahead on this. And then, of course, they may have no idea. Well, of course, they have no idea what the Fed's actually going to do. All they know is what the Fed said in a single speaking opportunity, which means next to nothing. Because as you said earlier, Don, the Fed is quite at odds within their own group about what to do next, and more so about what the timing is. What's the timing for what we're going to do? They're not sure. They're not confident in what to do either. So it's going to take some time. It's going to take some more data coming in about what's actually going on in the economy. The Fed wants that higher unemployment because that is going to be one of the guarantors that the economy is not going to overheat and that they can safely move those rates down without reigniting inflation. And that's what they're looking for. So that's one of those things that they're watching. And it doesn't matter if they get the number they want. That still doesn't guarantee anything. It never does. It's just an indicator that's going to let them move with a little more confidence. Probably not any more speed. They're not going to be in a hurry. They tried that before, and they really got themselves in trouble moving too quickly. And then it's really tough to unwind. So they're going to be quite measured, I think, and they're going to take their time making this happen. And sometimes that's good news and sometimes that's bad news. That is still to be determined. But anytime the news is coming out, something's going to happen in the market these days.
Well, and one thing that is changing is inflation is coming down, at least the inflation data that the Fed watches. That there are
Correct.
things they do collect data on, but they aren't concerned about, like food, though I'm sure they still go out to dinner, gasoline or energy, clothing. These things are prices that the Fed can't control. The Fed actually can't do anything about the irresponsible largesse at Congress. When Congress
Correct.
created a good portion of the inflation problem back in COVID by saying you can't go to work, so here's some money to support you. You can't go shopping. And well, groceries, that's okay. Pharmacy and medical, that's okay. They made some exceptions, but they shut down the economy and then dumped a bunch of money in. That's inflationary. Right. So
Every time.
what the Fed sees here on the core indicators is declining. But one of the major inputs of inflation is housing, and housing prices are not declining. So, as you just said, Perry, they're probably going to be very conservative simply because there's too many conflicting pieces here. And this happens to be the week, by the end of the week, we're going to know that the Democrats' presidential nominee is officially appointed and then confirmed by attendees at the party in Chicago this week, for a person who's never been elected to office nationally. She must have been elected in San Francisco, but nationally, we're dealing with a person who actually wants to take the COVID policies of spending money that we don't have and expand on those and expand the control of the economy with Jimmy Carter's. No, it wasn't Jimmy Carter. It was actually Nixon who tried price control back in the 70s. Yeah. And that was in the terms of the Federal Reserve president. I think it was Volcker who said this was an utter failure. If it wasn't him, it was the next guy in line. It would have probably been Greenspan. But price controls don't work unless, of course, you want to look at Venezuela and say that, are you happy there?
Good direction, you think? Yeah, I don't think
Cuba,
so. Yeah.
Russia, if that's what you want, that's what comes along with it. So, the question is whether or not the public is going to figure that out and buy it by November anyway. But more inflation is likely to be ahead of us than less inflation. This is really difficult to unwind. What you said earlier about taking years to unwind the fiscal stimulus that we had during COVID is something that emotionally we have not come to grips with. So the probability of inflation going lower than 2% is not nearly as large as inflation staying above 2% for another 3, 4, 5 years. So we may not like these price hikes, but they aren't going away. Now, the market's going to respond as a manic depressive. With each new little bit of information, it's either going to be hallelujah or you got to be kidding me. So, stay tuned.
And it's going to happen fast. Yeah, it'll happen fast.
Well, it is going to happen fast. In fact,
Yeah.
we'll talk about that on our next podcast. So stay tuned. Subscribe below if you want to talk to us or get a portfolio review. The information is there on the screen, and we'll be glad to meet with you online or in person if you're nearby. Have a great day.